All right, so here's what we're going to talk. I decided that this would be pretty timely since we're entering earnings season. I thought that a lesson on trading options and earnings would be something that would be useful to you guys. So this is one I spent most of the day updating this morning. So it's a lot of new stuff. My name is Mark Sebastian. That's me. I am the founder of Option Pit. We are a education and consulting firm. On top of that, I run a hedge fund that does primarily volatility arbitrage called Carmen Line Capital. We are in the business at Option Pit of teaching traders to trade kind of in a professional approach that similar to the type that we take, similar type we were taught. So we work with individuals, and we've got clients that have managed as much as $12 billion. We had one guy that was literally managing $12 billion, and he had 8 clients. Was kind of a cool dude that that consulting gig. That was fun. So now we're going to talk about trading today. Volatility can act like a headwind or a tailwind. So I'm going to teach you some real basic buy-sell decisions. All right. I'm going to talk about how to analyze the expected move ahead of earnings. I'm going to talk about building a trade around earnings, and I'm going to talk about earnings butterflies. So has this happened to you? All right. Mark, I get this at least 10 times every earnings season. Mark, market makers are cheaters. I bought these calls right before earnings. The stock that I bought is way higher, but I'm not making any money. Market makers stole my money. And the answer is no. The options are based on a pricing model. And that pricing model is forward volatility, underlying price, timed expiration, cost of carry, and strike price. Well, when earnings come out, one of those inputs changes. That's that forward volatility. There's a big move, and now the market's expectation of movement is now a lot lower. And so if one misinterprets how big the move might be in a name, even if the stock is way up or way down, and your long calls or puts, then you will have a loser on your hands, which is why really the key is strike selection. All right. So now there are 3 main types of volatility. You've got realized, historical, and applied, and each is useful in their own way. All right. Realized is how much a product is moving right now. It's that daily move, the immediate move. It's kind of what's happening today. And I'll look at 10-day historical. Look at it. Here's one, an older one of Google. And what I want you to notice is take a look at where you see that E. What do you notice? You get some big realized moves. Well, with those big realized moves, other things change. All right. So historical volatility is how much an underlying has moved in the past. It can be viewed in monthly increments, and it tends to be mean reverting. All right, and that's for getting a historical perspective of how much something has moved in the past. I like looking at kind of historical 20 and 30-day volatility. If I really want to see kind of a long-term trend, I'll look at as far out as a year. And here I can show you a picture of what that graphing can look like. This is the Russell 2000. And if I pull up a chart, there, and I want to look at vol, here's a good picture of 20-day volatility. Here's 30. And now I'll pull up a picture of 360 days. So this is a year of volatility. So when I say volatility is mean reverting, guess what? Volatility is mean reverting. It's about as flat as a pancake. This is the IWM. That's about as flat as a pancake. So, you know, you can see the mean reversion. And finally, and this is the big one, there's implied volatility. It's based on the price of options. It's actually an output, not an input, right? The model, as I said when I was discussing this, the model uses forward volatility. Well, if you can guess how much something is going to move going forward, you need to call me right now. If you're effective at guessing forward volatility or at predicting forward volatility, if you're good at it, give me a call right now and we'll end this presentation. I will go get us, a couple $100 million of capital and we'll make a blasted fortune. All right. And there's a reason that my phone isn't ringing off the hooks. It can't be done. So what do? We have this thing called implied volatility. And implied volatility is really the market's best guess at what forward volatility is going to be. And it comes out of the price discovery of options. So really, that implied volatility is derived from these prices, these calls that are 234, 235. They produce the volatility, all right, which is 16.6%, 16.65. All right, that is produced by the pricing model. So there are indexes that you can look at that'll give you a good implied volatility, or you can use your broker platform. So this is one of the vol indexes. This is pushed up by SIBO. This is the volatility of Goldman Sachs. All right, VXGS. And again, if you look at that 200-day moving average, it ain't going anywhere. All right. So over the long term, and you can look up, there's implied volatilities. Obviously, there's the VIX, which is on the SIBO, on the S&P 500. There is ones on gold, silver, oil, Amazon, Apple, you name it. There's tons of these indexes. And the thing to remember is that, again, it mean reverts. So when it's really expensive, it's going to get cheaper. So take a look at this. This is Goldman Sachs. This is from this morning. All right. That earnings, it's been down. That'll be a fun one to trade here shortly. Look at that 50. Look at that 200. There's no mean reversion there. There really isn't. There's, people say there's waves. Yeah. Now, if you look at this chart, you got a much clearer view of mean reversion in VXGS. Now, obviously, you've got some events back here that have pulled volatility higher, going backwards. But it's pretty reverting. So the key to remember is that a stock price can go anywhere and stay there, and volatility can go anywhere, but it won't stay there. So implied volatility can go really high, all right? So understanding that will help you with buy-sell decisions, all right? And the basic is, with starting, real simple. I don't even need a slide for this. So when implied volatility is off the charts high, do you think it makes sense to buy options? Generally. There's always exceptions, but what do you think? No. Correct. Good. All right, so, and when it's super low, does it make sense to sell volatility? No. Real simple. Real simple. All right. So now, the next key, and I've got a big long presentation on using volatility and directional trading and really managing that implied volatility, but I have 45 minutes to present and I have a lot of stuff that I want to cover and I want to have some time to look at trades in a live environment. So a hard delta. All right, a hard delta is a option where it's price exposure to the market. All right, remember I mentioned those 5 price pieces, underlying price that determines a stock. So a hard delta is going to have that a stock price or index price sensitivity that doesn't move around very much if implied volatility moves around. All right, and that's going to be options that are in the money or kind of at the money. You know, I can tank if I buy an at the money option and I tank volatility. We'll get then the underlying rallies $1. That option will still gain 50 cents because it's an at the money option, or like 53 cents, something like that. Right, now, a soft delta is a delta where really its value is coming from that volatility. And when people get beat bad on earnings plays, they're on these buys. They're often buying soft deltas, ones where the volatility really determines whether there's going to be a good trade, whether the trade's going to win. So if you understand the difference, it can really help with that strike selection. And so, you know, just to kind of get a look at it, here you have, and this is IBM. This is today. They've got earnings tonight. So we're going to play around with IBM. I figured let's play around with something that has earnings tonight. You can see these are kind of in the money. The stock's trading at, when I took this flash, 166.85. Right there. So, you know, my 167.5s, my 170s, and my 172.5s, these are all heavy delta options. These are going to be harder deltas. And on the call side, the 65s, 67s, you know, really everything from kind of the 65, 67, those are all hard deltas. Everything around here on puts, and everything in here in calls. Now, your softer deltas are these little cheapy guys. All right, you got a $160 stock, and you've got an option worth less than $1. Guess what? That's a soft delta. So I would look at the 72.5s as kind of a soft delta, the 75s, the 77s, you know, everything down. Those are very inexpensive and they're very volatility determined options. So the key to understanding really, and then we're going to come back to those soft deltas because we're going to build trades around this. All right. The key to understanding earnings is to understand that straddle price. All right. Now, what is the straddle? I'll go through that in a second. All right. So the straddle is the at-the-money call, the value of the at-the-money call plus the at-the-money put. All right. So in IBM, basically you could look at the 167.5s. All right. I'm a little more exacting, so I'll use a strangle. But you would be the value of the 167.5 call plus the value of the 167.5 put. All right. That at-the-money straddle price of the weekly, and it represents about 80% of a standard deviation. And it's right about 58%. It's about 58% kind of as much or less. So that at-the-money straddle price of a weekly option, so we've got IBM and there's options expiring tomorrow. They give us a very good glimpse at what the market is expecting movement. So these straddles are rarely dead on, but over time, when traded over and over again across hundreds and hundreds and hundreds of trades, they're pretty dead on. My friend Russell Rhodes from the CBOE has done some studying on earnings, buying and selling straddles. And what he found is buying straddles loses a little bit. But guess what? Selling straddles loses a little bit. All right? And that's not definitely, that's, so think about that. So if you buy on a straddle, you are going to lose a little bit over time. And if you sell a straddle, you're going to lose a little bit over time. How is that possible? What do you think? I'm going to give you the answer right now. You ready? Well, take a look. IWM's trading 133.75. And all right, and my 134 calls are 240 at 242. The puts are 261 at 263. That bid-ask spread. So the fact that I have to sell a straddle at $5 and I have to pay $5.55, that's where the loss occurs over time. So to think, you know, we're going to talk about that, but to think that there's some edge in buying or selling specifically done over and over again is just a complete fallacy, and I don't know who propagates it when it comes to earnings. All right, statistically over time, does selling options win? If you do it millions of times and you have endless capital, yes. All right, but earnings, no. So that's why, generally speaking, I honestly don't do a lot of earnings plays because I think they're a crapshoot. But I'll show you how to analyze them anyway. So now this is a weekly straddle. This is IBM. Now at the time I took this picture, IBM was 166.76. This is from today. All right, and the call was 246 at the 167.5, and the put was 207. These weekly straddles do a pretty decent job. All right, and what ends up happening is more often than not, the underlying moves less than the straddle is predicting. However, when the straddle is wrong, it tends to be really wrong, not by a little. All right, so, and when it tends to be really wrong, those tend to be really outsized moves. We've seen that in IBM and in Google and in Amazon and in Apple. There's been a lot of those. So now, the IWM strangle. So now I'm going to, because this stock price is almost dead smack in between 165 and 167, what I'm actually going to do is basically analyze this from buying the 165 put and buying the 167.5 call. All right. So the strangle is about $4.52. So with the stock trading 167.5, you know, just back of the envelope, we're going to call it about $1 from both strikes. So that's going to make that straddle, that strangle, pricing in a move of about $5.52. All right. So that's going to be about about 3.5–4%. So knowing how much the market is looking for a move is valuable. Now the key is then look at historical moves. All right. So it's good to know when a straddle is rich or cheap. All right. Rich ones don't necessarily need to be sold, but cheap ones may be an opportunity to buy. Sometimes. Now, one rule. I'm going to give you this rule right now as a trade. All right. I never buy options out of the net straddle or strangle price. So with IBM trading 166.76, all right, here's what I do. Take a little calculator here. And all right, so 166.76 plus 552. So I would never buy a call that is above the 172. So I would not buy the IBM Jan 172.5. Now if I subtract that 552 back out, and then I subtract 552 again, 161.24. So I would never buy a put option below 162. So I might be willing to buy the 162.5s. I will not buy the 160s. All right? That is where there is value. All right? That is where there is value. So, all right, so now let's talk about how to directionally play some earnings to your advantage. So I'm looking at IBM in earnings this week. I'm looking at it right now. All right. I want to use spreads to my advantage. The thing is that most people don't know that they should not buy options outside of that strangle, and it pushes around earnings those options to be way too expensive. And here's where you can create some edge. All right. So the use of the spreads is key when earnings. It takes advantage of volatility in that soft delta, and I keep the hard delta. So, you know, here's IBM. I think the stock is going to go down. All right, I don't know about you guys. It's had one earnings where it's gone up, and most of the time it gets beaten over the last few months. All right. So let's just say I'm bearish. All right. Suppose I think IBM is going to go lower. What if I bought the 167.5, 160 put spread instead of an outright 167.5 put? Let's look. All right, my 167.5 put is $3.16. All right, I could also buy the 165. But in this case, I'll do the 167.5s. And then I can sell the 160s. Get 62 cents. So I'm getting a little volatility premium in selling that, which is nice. I like getting volatility premiums. So now let's say that, you know, my cost of my spread is going to be 316 minus 62 cents, or about $2.50. So I'm paying $2.50 to make 5. It's a payout ratio about 2 to 1. So now what if I bought that 167.5 put for 316? And IBM also goes to 160. Well, my cost is 316, and if it goes to 160, I'm going to make $3.34. That's about 1 to 1. In order to make my full $5, I need IBM to drop another $2. So there is an edge in buying this stuff that's at the money that is hard and selling this cheapy stuff that gets bid. There is an absolute trade there when one has a directional opinion. So that is one way. Now, a cheaper alternative is to set up the long inside of the strangle price, so less than 450 away from the 165s or 167s. Really is what it amounts to. So, and then I sell that worthless stuff outside again. So in this case, let's say now I think I think IBM's going up. All right, I'm Warren Buffett. Apple is darn it. IBM is a long-standing great company that's going straight to the moon, and why wouldn't you want to own it? Unless you're a jerk. Right? Well, I can buy those 170s, which are a strike that I established I'm willing to buy, and I can sell a 175 and get 30 cents out of it. Not bad. So I pay about $1.10 for that. So I'm getting about 4 to 1 if it goes to 175. If it goes to 175 and the other one, I'm only getting out about 3 to 1. Right? The other piece is that if it goes less, if it goes to 171, 172, I'm actually going to make a lot more doing the spread than I ever will going just flat out long call. So I really like that. So generally speaking, when I have an axe to grind and I really want a directional trade, this is, this kind of buy something inside the strangle or straddle, but a little further away from the money, and then sell a bunch of junk outside is one of my favorite trades. Right now. So earnings winced you, and this is true. All right, there's this concept that people think of an earnings bid up when options get bid. All right, and that's not really what happens to earnings in earnings season for most companies. Now there are these things where earnings get bid. All right, where a name like Tesla, maybe there are a bunch of call buyers or things like that. All right, but generally speaking, what happens is traders know that earnings are coming up, and so they kind of hold that straddle price. So if I buy a straddle for $4, and then a week later that straddle is still worth $4, even though I didn't make any money, implied volatility went up. Does everyone kind of get that? So if I buy something for $1 with a month ago, and then I buy an option for $1 with a month ago, and then 2 weeks later it's still worth $1, I didn't make a red cent. But implied volatility is up. All right. Would you ever consider buying within the straddle price in a further month and sell the earnings month? I don't like earnings calendars. That's basically an earnings calendar. But if you're talking about an earnings diagonal where you buy something long-term and sell something near-term against it, it's not a bad idea. The only issue you have is that when you buy a longer-term option, you're buying a lot of Vega. And what is Vega? Vega is the options exposure to changes in implied volatility. So the thing you have to be careful of when you're buying longer-term options ahead of earnings is that earnings month isn't overly, or that non-earnings month isn't also really expensive. All right. So now the area where there can really be options that get bid up are these little wings. All right. Now I let off that story with that market makers are cheaters, right? That's how I started today. Well, the reason why I hear that story a couple times a week is because there are a lot of dummies out there that buy way out of the money options hoping to hit it out of the park. Sell them happily. Sell them those options as a part of a spread. You want, you're trading Apple or IBM, and Apple's 120 bucks. Somebody wants to buy an earnings 130 call from you, sell it to them, and then buy something underneath. I mean, look at how these wings can get bid. Look at how hot they can get. I mean, it's amazing. So here's the best kind of complex, simple trade that I like if I'm going to do earnings, all right? And then we'll spend some time looking at a couple ideas, all right? So the out-of-the-money butterfly is, in my opinion, the best way to trade directionally. The key is to set it up right. So, because they're cheap. So what I do is I set the long near the end of the expected move and then sell shorts further out of the money, and then go further and then buy something for junk. So here's the setup. I buy a call or put at the edge of that earnings straddle. So again, in IBM, I'd be looking at the 170s or the 162.5s. Then I sell the junk that has some real value, and then I buy a cheapie to manage the margin. All right. Cheapie to manage the margin. Andrew, can you mute yourself? Andrew Keene. Thanks, dude. Now, here's Google. This is Google. They have earnings next week. So I would usually set this up a day or two or the day of earnings. So a trade I might look at is long the 850s, short the 870s, long the 900s. And why? Well, let's look at Google. All right, Google's trading 826.35. So really I'm looking at a $35 strangle. So I would want something between 860 and 790. So in this case, in Google, I buy the 850, which is inside, clearly inside. I sell the 870 that's outside. I get so I'm paying $8 versus $355, and then I buy the 890s for $1.40. You know what? Excuse me. I misread something, and I want to fix that. This would be 140, and this should be 140, and this should be 235. 6 1/2 dozen the other, but this should be correct when you see it. I apologize. I looked at the wrong strike. So if I buy an 850 call for 8, I sell the 870s at 355, 3 double, if you will, and then I buy the 890 call for 140, I end up paying $2.35 for a 20-point butterfly. I'm getting 10 to 1, or 9 to 1, whatever you want to call it. That is, and if I do some work, I can do better than that. That's a nice little payout. That's not bad. It's an inexpensive play that can make me a lot of money. All right, so now vol premium sells. This is what kind of going full circle. There are a lot of people that think, oh, I should sell a strangle. I should buy a calendar that gets me short front month and long back. Study after study proves these don't work.
all right? Unless you do them really well and smartly. Now, I'm saying for now, all right? Now, if you really dig in and you get really good, you may be able to sniff out some winners and losers, all right? But if you don't know how to sell premium into earnings like a professional, don't bother. Vol premium sales around earnings need to be done in a hedge format with some thought and usually some directional bias to win. They really do. All right, and you know, so the type of stuff I like for a vol premium sale would be like a broken wing fly or a 1x3x2, things like that, where I'm getting net short premium, but I'm also a flat buyer of options, things like that. All right. Now I'm going to quickly do the summary of my offer, then we'll look at trades. All right. Now, summary: vol rate reverts, implied volatility helps form positions, straddles key, use spreads, buy inside the tent, and sell junk. So now, then on February 4th, wrong title, darn it. On February 4th, we're doing a presentation called Trading Long Options and Managing Gamma. You go to optionpit.com/gamma. It's $297 when we list it in our store. Today I'm doing it for $197. Go to optionpit.com/gamma. And what it'll teach you is how to understand how to buy options, learn how to manage straddles and strangles, use volatility to pick the right option to buy or sell, take advantage of volatility to produce more income, ride volatility cycles like Andrew Keen, the pro surfer, manage risk and reduce portfolio risk with offsetting longs. All right, and $197. Now, why am I showing you this? Because that course, which is February 4th, is within the next month, so that means it's free with the subscription Option Pit Live. All right, our monthly, we have a daily chat room that we run. All right, and we're in there for a few hours a day between me and Andrew. Andrew's my number 2. Andrew, not Andrew Keen, Andrew Giovinazzi. Different Andrew, 2 great Andrews. All right. What you'll get is our strategy letter, which executes trades, manages them, follows them through. All right. You're going to learn to trade some income strategies. You're going to learn to extract dollars from the market. We're going to teach you how to own premium. You're going to interact with me. And so you get this kind of newsletter service where we follow our trades. You get access to our chat room, and you're going to get this course, Trading Long Options and Managing Gamma, for free, and on your trial, which is just $17, which I think is a steal. So you're getting what amounts to a $300 value for $17. All right. And now, one, do we have any questions? And 2, do you guys have any stocks you want to look at? Throw me a stock. Heck. Yeah. I will turn that off. I'm just taking you to, I'm just cutting out the link here. All right. I noticed you were using LiveVol. What do you think about the screeners? Well, if you look in LiveVol, here's how much we like LiveVol. We have our own screeners in LiveVol. So what you might notice is, remember my firm is Option Pit. There's actually one that's public, these are all available within LiveVol, called Option Pit Scans.
and there's some ones that we've built with the AutoShip guys. Now we've got some proprietary ones we're working to build with them, but that is where we are now. All right, we have about 3 minutes. If you have anybody have one stock that they'd like to look at that has earnings coming up, speak now, or I'm picking. All right, I will pick. Let's see who's got earnings tonight. Where's my calendar? All right, there we go. We got a good one. Qualcomm. I like Qualcomm. That's a good one. They have earnings next week. Was Schlumberger tonight, or are they next week? Schlumberger is tomorrow morning. All right, this will be a fun one to look at. All right, so let's take a look at a couple things here. All right, the stock is 87 bucks. You can see the volatility is bid. So right now in Schlumberger, they are looking for about a $2 move. So they're looking for a move between out to about 85 or up to 89. All right, if I look at historically, the straddle has been, you know, this is toward the low end. This is absolutely toward the low end. So that's fascinating. So the straddle is really cheap in a relative sense. $2, that's really about as low as it's been. And actually, if you look at a chart of volatility, now I'm going to look at implied vol, and I'm going to get rid of this, and we'll look at a 2-year thing. You can see this is the cheapest it's been in front of earnings in 2 years. So generally speaking, this might actually be a straddle I would buy. But better yet, why don't I figure out a way to make some money around it? We'll take a look at, we're going to look at skew now. And then, all right, so let's take a look at the volatility curve. All right, and a couple things I notice here. All right, the 87s are actually kind of expensive right now on a relative sense. And then, you know, the 89.5s and the 90s, you know, there might be something there. Maybe the 89.5s look like a sale. And you can see there's some real nice stuff out at 84 and 85. I can get some decent premium. So I think this is actually a decent butterfly candidate to go long. And, you know, I could do a lot of things, but, you know, a trade I might be interested in would be the 87, 84.5, 89.5 for $1. Looks like about $1.60. I mean, that's not a bad little play. This is a reverse butterfly. Now, that would be that's an interesting enough non-directional. Now, do you have any directional bias? And then I'll stop here. Actually, I think I need to stop now. If I had a directional bias on this one, I don't know. I gotta look. If I had a directional bias, I think I think a call spread or a butterfly makes a lot of sense. I mean, the 88, 89 and a half, 91 butterfly is 58 versus 38. So that's 20, it'd be 25 cents to, that's a really good payout ratio. All right, folks, on that note then, I will let you guys run, and I want to thank you guys for coming. And I want to say I really appreciate the Investor Inspiration people for having me on. They're a great crowd, and I love presenting for them.